Thank you, everyone, for joining us today. Very excited to have a chance to speak with Charles on a topic that I know we've seen a lot in headlines, that of copper and really just broader resource equities. What we're seeing is just an interesting story develop from the kind of classic supply and demand mismatch, and glad to have Charles be able to expand upon that. As a starting point, perhaps for those of you who are not familiar with VanEck, I can briefly give a quick history. We have been around for quite a while. Actually, the firm founded in 1955, and the heritage of VanEck and our history has really been shaped around gold, natural resources, emerging markets where you find a lot of these deposits, etc. And for the better part of the first 50 years, that was what our business was. In 2006, we launched our VanEck Vectors ETF lineup. That has helped fuel some of the growth from an asset standpoint. But we still retain the essence of being experts in the field of resources. And so when you think about who knows this stuff, I would posit that VanEck is certainly amongst the best on Wall Street. So if nothing else, I think it's important to just understand our history and having decades of experience in this space. I had mentioned some of the growth that we've seen from an asset perspective, and what you can see here on the right is our total AUM. That number is a little stale. We've recently crossed the 200 billion mark, which is quite a milestone. And the core of what we do, while diversified across asset classes, you can see a great amount in those very spaces that I had mentioned: gold, precious metals, emerging markets, equity and debt, resources and commodities. That still is the lion's share of our assets, and reflected in what we're speaking to you today. At the end, I'll speak a little bit to some of the different ways we can utilize some of these funds to capture these themes that we're going to discover and talk about today. But if nothing else, hopefully this gives a good feel for who VanEck is. So getting into some of the discussion today, I would start out by saying certainly feel free to submit questions. We're likely going to hold addressing those until the end, but we do allocate some time to be able to speak to questions and answers. And we will always certainly do our best to make sure we get individual answers back to each questions if we don't cover them today. You can see Charles on the screen. Charles has been with VanEck since 2003. He's been here for quite a while, but that is not the bulk of his career. Decades prior, all in and related to resources, in particular metals, minerals, mining companies, as an analyst. He currently is a senior analyst on our Global Natural Resources Fund with a focus on industrial and precious metals. Charles is certainly the one to be able to speak to us about copper. Charles, maybe just getting into it, I had alluded in the start a little bit about some of just this concept that we're seeing at play now, hearing just so much about resources, copper in particular, but in relation to AI, data centers. I mean, these are the key inputs, these metals effectively to fuel this global growth. But we're faced with what really is that kind of classic economic supply and demand curve mismatch here, where the way I understand it is we've got a outpaced amount of demand for a shrinking and troubled supply. Maybe that is a starting point. Could we just kind of summarize the story on the supply side starting out, and then maybe just a sort of a high-level summary on the demand side, and then perhaps we can get into some of the specifics on each.
Yeah, sure. Thanks, Patrick, and thank you for everyone joining today. It's an honor and privilege to talk to you about a space that I obviously like a lot and have been involved in for quite a long time. So let's start off page 4, really to give you a summary of the way I see this world of natural resources, metals and mining relative to some of the demand factors and demand trends. And so if you really think about the key takeaway from all of this in this conversation today, is that copper is at what I call a crossroad, right? It's at this crossroad between accelerating demand, which we will get into a little bit as well, and then at the other side, at a place where we are seeing constrained supply. So clearly a crossroad of accelerating demand and constrained supply. And what we are seeing is a global mega trend driving demand. And as Patrick, you've mentioned before, some of that's data centers, some of that is energy transition. And in a slide or two, I'll talk a little bit more about that. But on the supply side, which is where our expertise sits, we are really seeing an industry that's structurally undersupplied and or an industry that is structurally struggling to maintain the current supply. And as I will show you as we go through these slides, to grow supply going forward, we will need billions and billions of dollars, to be invested, and we will require decades for the supply to come online. So that's sort of the summary. Maybe I can forward to page 6 to put this all into a big picture context for you, and then I'll turn it back for you so we can get a little bit more involved in the specifics. So as Patrick said, there's this discrepancy between where supply is moving and where demand's moving. So this slide is a very quick summary of the supply line, which is the orange line at the top there, and where mine supply and secondary supply is going, which is the blue and the green sections there. And then it indicates to this gap between demand and supply, or that the market will be in a deficit going forward. And that's the issue that we are trying to address. That's the issue we're trying to understand better. And as you can imagine, when we have this discrepancy between demand and supply, we obviously get price action. And in this case, we get good commodity price support because the outlook is that demand is going to be stronger than what supply would be. So if I can just give you a couple of things maybe on both the demand and the supply that I think is important, and then we can get into each one of those. If we look at the blue line, the supply line, the primary mine supply, the reason why it's flattening or falling really is because of the structural trends that I spoke about before. And it's important we know that they are structural, meaning that they are embedded in this industry and they cannot be changed quickly. And those things are things such as falling grades. The mines are just simply getting older. The lack of new investment, lack of capital spending to grow new supply. The fact that bringing on a new mine into supply and ramping it up to full capacity is just simply taking longer than ever before. This industry is a complex industry. I don't think people always appreciate how complex the mining industry is. And then because of all those factors, supply historically have been overstated when we look at forecasts relative to the actual demand, the actual supply numbers that comes through. Then if I quickly turn into the demand side, that orange line again, as I said, these are mega global trends that's occurring in this slide. According to the S&P Global data, they expect demand between 2025 and 2035 to grow by around about 30%. So what's driving that demand? There's a bunch of things. There's obviously the traditional economic drive factors that we can talk about, but the things that's more new that we are talking of is electricity and electricity distribution. So whether that is electricity in the concept of AI data centers or electric vehicles or energy transition, but anything within the electricity grids, it's another example. That's the core things that we believe over the next decade or so will be the driver on the demand side. But I'll give it back to you, Patrick. Thank you.
Yeah, that's a great kind of summary of the two sides. Maybe digging a little deeper, you had just spoke to electricity. Can we kind of expand on that? I think that being a big driver and kind of contributor to understanding this supply and demand mismatch. And then anywhere sort of further on specific points around the supply that we're going to see affect this on an ongoing basis. We understand and see the gap related here, but maybe let's dig a little deeper on what's going to contribute to that.
Sure. Let's talk about electrification and how electrification is scaling up around the world. Again, this is a global phenomena. We're obviously seeing a lot more what's going on in the United States, but what this chart shows you is electricity demand in terawatt hours projected from 2025 to 2035. And if this holds true, the electrification or power demands over the next decade could grow somewhere around 40 to 45%. This is sort of the base case scenario of electricity demand. And you can see the sort of new emerging sources in this slide. It's called transportation. That's electric vehicles, energy transition as the thematic. It's obviously a little bit older than what data centers are, so it's a bigger trend already. And then the new thing that's going through here is data centers. Now, if we think of electrification itself, it's a much broader demand driver for copper than just more power. Yes, it's more power, but it's more new power, so new generation that's required. It also means that the grid in itself needs to be expanded, because that's how we transfer or transport electricity, is through the grid, which historically has been very heavy copper in itself. Is also the transmission of those electric currents, electrons that's going to flow through the system that needs to be upgraded. And then overall, just the plain distribution side of it. So there's multiple levels behind this sort of electrification that's scaling that maybe is not always appreciated by everybody when they think about where we are going into the future. So if we then look at how this impacts copper demand specifically, I think that's important to understand, is that electricity demand really will impact copper demand. And there's a couple of reasons why it will impact copper so much. Well, we need to understand what is the properties of copper, right? So copper is a really good electrical metal to conduct electricity or electrons, but also it has significantly positive thermal properties. In other words, it doesn't heat up when that power gets pushed through those wires. The other point that's important here is these wires, copper wires, can be molded into very thin wires. And because it can become very thin wires, it's ideal for electrical wiring. Now, people might say, but what about other things such as aluminum? Well, yeah, sure, aluminum, you can do similar things like this too. But just in this context of having a thin wire, you need typically a wire that's 4, 5, 6 times thicker or bigger for the same type of electrical current, and it doesn't last as long as a copper wire would last. So that's one thing that drives it. If we look at the slide specifically, it really only shows the sort of new entrance of copper demand, meaning the grid, electrical vehicles, renewables, and data centers. And what we're seeing that at the moment is really nearly 1/3 of global demand, and clearly that is the driving factor into the future as we see it. Now, traditional copper demand, which is just us living around in our houses, our technology we have, air conditioning and other things like that, that demand driver is growing at sort of like 2, maybe 2.5% on an annual basis. And that's a great underlying driver for copper demand. But these things that I've showed you here is clearly the key driver as we move forward.
So what I'm hearing, Charles, what I'm hearing basically is our electricity bills are not going down anytime soon. Is that fair to say?
Unfortunately, they're not going to go down soon. That's correct, because we all want more connectivity, right? Yep. We all want better power. So unfortunately, they're not going to go down for a range of reasons, right? But if we go into the supply side, there's a couple of very key things that I want to highlight on the supply side and why I believe this is a structural issue. And this is most probably, if I think of the balance between demand and supply, I get a lot more excited about the supply side, and why I feel comfortable with the view that I have on the copper market is driven by these issues that I'm about to mention for you. So first of all, the first structural issue we have in the global copper industry is that grades are declining. What are grades? Well, grades are indication of how old our current existing mines are. And as you can see, the grades there in the mid-1990s were run about 1%. They've gone down to call it about 0.6% at the moment is where we are. Now, some of the big mines in the world, like Escondida, most probably the world's biggest copper mine, has a copper grade of 0.3%. So clearly, this trend is a trend that's well in place, has been in place for a long time. And so when we see these grades declining, it means that the companies are just not as profitable as they used to be. They need to remove a lot more dirt, not valuable dirt, to produce the same amount of tonnage. And to change this profile is nearly impossible, because the only way you can do this is by investing in new mines, right, which we will get to in a second. The other important portion of this slide is people say, well, the commodity price has gone up X. Does that not mean the existing mine can produce more tonnage? Sure, they can, but it's not a similar X factor as maybe a 2 or a 3% increase in volumes. And the main reason is because these grades are deteriorating and have deteriorated so more. So you basically have to deal and live with what you have on the supply side as it is pertaining to the grades in itself. So if the next key thing that I see that's important on the supply side specifically has to do with capital spending. So if we think about capital spending, think of this as new mines coming online, right? So you can see going forward, we are seeing capital spending on this industry being flatlined. So theoretically, all things equal, if CapEx does not increase, supply most probably will not increase either. So that's the core out of the slide. Now, if you take that blue or gray bars, you sort of get into the real nitty-gritty of that. Historically, the percentage between sustainable CapEx and growth CapEx, meaning new supply, used to be about 50-50. If we go back to the 2010 to 2015 timeframe, growth CapEx was actually around 80%. So we saw sort of into the latter half of the 2010s, we saw a lot of supply coming through because a lot of CapEx was spent into the growth side. As I look at those gray bars forward, where I said historically it's 50-50 sustainable growth CapEx, I see growth CapEx at the moment as low as 30%. Why is that important? CapEx numbers are what they are, but if we don't spend more on CapEx on growth projects, we are not getting new supply. And we are not spending new money on CapEx, growth CapEx, because there's just not so many assets and operations and abilities to grow our supply as we see the world through the current lens of CapEx. The next key feature on the supply side is the fact that it just is taking so much longer to bring a mine onto production or ramping it up to full capacity. So if you look at the top there, 1990 to 1999, sort of that decade, it took around about 6 years from exploration, basically day one, until we started building and construction and ultimately produce some type of copper. Fast forward to where we are in the current time frame, 2020 to 2024, we're around about 18 years. Now, that means the CapEx that we're sinking today, if we think back to the previous slide, that supply is only going to come on in, call it 2040. I'm talking about demand growth in the next 5 years. So we've got a real conundrum in that case. A perfect example of this is is a mine in Arizona called Resolution. Resolution is a mine, or let me rephrase, is a project that at this stage is 20 years old. At this stage, they've already sunk in $2 billion into it. It's estimated to sink another $6 billion into it. And as we stand today, 20 years later, we still do not know when the first ore will come out of Resolution. Perfect example of how complicated and difficult it is. And sometimes it's just things such as permitting, environmental issues, community issues, or political shifts that take place. But quite frequently, it has to do with infrastructure, whether it's infrastructure, road, power, water, or labor. So a lot of factors that feeds into this, why I believe that it's going to take longer to bring on new supply than we historically have been used to. The last sort of thing that I think is important to talk on the supply side specifically is this notion that we always are over-optimistic on when production will come online. And if you look at this chart, you'll see the historical estimates, which is the gray bars there, are reflective relative to the actual or the current estimates, right? So historically, you've seen pre-2025, we were overestimating sort of the supply relative to what actually came through. And again, most probably as we move into the future, we'll get a similar thing where forecasts will be overestimating what actually ultimately comes through on the demand, comes through on the real production volumes. So I'll finish with this, Patrick, and then we can go into some company-specific or commodity-specific question if there is any. The point here is on the summary slide is really that we see the structural issues, right? Structural issues on the supply side. I've mentioned them. I can go through them again. These structural issues are not easy to fix, no matter whether you've got the money. It's a time issue more than a money issue. And secondly, we are seeing some real demand drivers that I believe will keep this commodity tight. And a lot of these demand drivers are what I would call geopolitical demand drivers, meaning AI. There's a very clear race, a global race on AI and who wins the AI race. And if you believe that that is the next race, then you have to believe electrification is part of it. And if you believe electrification is part of it, you have to believe copper is part of it. And because of that, what we have seen over the last couple of months from the US administration, we have seen things such as copper being put on the critical minerals list. We have seen things like Project Vault, which is a $12 billion fund in which they will be buying copper concentrate as a strategic reserve. And we're seeing similar things such as this in China. So the thematic has gone from what we historically used to speak just to the fundamental supply and demand issues to clearly a lot more issues outside of that that maybe is not daily seen or valued by everybody out there. Thanks, Patrick. I'll give it back to you.
Yeah, that was fantastic, Charles. Some really good information there that we covered. You know, it almost feels in some cases that this is just an opportune time to be involved in this space, really, because we're going to see not just a couple years of this occur, but this is multi-decade sort of backdrop here. So, you know, with that in mind and this great setup of this supply-demand mismatch, and we're talking about this occurring over periods of decades, not just years, I kind of then have to wonder about the companies themselves and the financial health. Is this a good entry point? Are these companies on a traditional basis overpriced right now, or maybe, you know, appropriately priced? And then also maybe as a wrap up, just, you know, any kind of just risks to be aware of that that might kind of put a little pause on this very long and multi-decade story that you just unfolded from the macro side.
Sure. Well, there's always risks, right? So let me start with that one. There's risks, what I would just call GDP risk, right? So we need to understand on the commodity demand side, the bulk of demand is just traditional GDP. So if we have a correction in GDP growth, that will obviously have an impact on some of the demand trends that we see. And then the obvious other one is if AI doesn't roll out at the speed that it rolls out, that would be the obvious risks that's out there that anybody can come to a conclusion on. There's always in the world of commodities, always this conversation about substitution, right? Can I use something different that's cheaper to achieve the same thing? And the short answer to that is yes, you will. But the short answer to that is also no, you can't. And so to distinguish that for a quick second is you can always fine-tune your consumption or your demand of a certain commodity, and I can go through all the commodities like that, but your bulk drivers to these broad mega trend thematics is very difficult to substitute. So in a data center, we can, without a doubt, substitute some of the connectivity specifically within the data center. We might be able to substitute, maybe let's call it the last mile of connectivity between the data center and the plant. But there's a lot of other things that is the bulk of this demand thematic that I spoke about that cannot be substituted. So that's the one thing I'll say to you. On the equity specific question on valuations and the financial health of these companies, you know, if I go back when copper was sort of trading at $4.50 more or less there, the majority of this industry was actually cash flow negative, despite the perceived elevated price of the commodity at that point. So we're talking about a year and a half ago now, right? Which goes back to why there's no capital spending taking place at the moment, right? The industry has changed. They are now moving into an environment where they are cash flow positive and free cash flow is starting to be generated. And for that trend and the general financial health from a cash flow point of view is obviously being rewarded from a valuation point of view. The benefit that we have is that these companies in general have very low debt. So if you think back to 2015, the net debt to EBITDA was maybe 3-4 times for some of them. Most of this industry is now going to a cash positive situation. So the way I look at these companies are a massive cash flow being generated. What are you going to do with the cash? Is this coming back to shareholders? I think that is a very strong probability. That will be rewarded, I assume will be rewarded by the market. And again, on that thematic, the risk would be is are they going to put this money back into either M&A or CapEx that's not warranted, where the IRRs are just not there. So that's hopefully gives you an idea.
Yeah, it certainly does. Coming to being mindful of time and towards the end, I would just urge any of our audience, if there are questions, certainly type that into the chat. I wanted to at least just discuss some of the ways that we offer exposure to this particular story around copper, but even more broadly, just around resource equities and commodities themselves. As you can see here, we have a whole host of different options, some fairly specific and capturing particular parts of the natural resource scope, and then others that are really, covering across all different parts of the resource equity and commodity landscape. The fund that Charles sits on as Metals Senior Analyst, our Global Resources Fund, as you can see at the top, certainly will have exposure to this copper theme amongst others. And we also have the other side of the coin where the majority of these are resource equities, but if you're looking for the futures-based commodity exposure themselves, something like our CMCI commodity index, which is available in a mutual fund, as well as a ETF, is another part. Maybe in the spirit of some of those questions, I would just say real briefly, if you could, Charles, thoughts on the commodity versus the equity. Is there a better way to get exposure to copper, one versus the other?
Well, it depends on your financial acumen, I guess, is the way I would describe it.
Yeah,
right?
that's fair.
The equities is a if you think of the equities in general, and this is the way I think about the equity world, is beyond just the commodity price, you've got company-specific self-help, for a lack of a better word, that can drive valuations and can unlock value. And that's the way I see this world, right? The equity side is much more thematic than just a pure supply-demand driven model.
Yep, that makes sense. And just wrapping up, excited to announce, going back to some of our products, that we do have a copper specific offering, our copper and green metals fund, which is ticker EMET. I would certainly urge all of you to take a look at that particular ETF, which really would be the most direct access to a lot of the themes that we discussed around the copper market and some of this macro story that Charles laid out that is exciting and presents a real opportunity for multi-decade return potential. So perhaps with that, absent any other questions, we can call it there. I would say as sort of a final, if there are more questions, if there's a desire to speak with us, please do reach out to me. My email, pfinn@vaneck.com. I'm more than happy to try to put in touch our advisor and investor base with some of the experts like Charles and others. So please do be in touch if there's further questions. And we do thank you all for your time and look forward to having a chance to continue to be leaders and thought leaders in this space. So thanks again, everybody. Thank you, Charles. Appreciate that, and enjoy the rest of the week.